We are just going to talk about the major stock exchanges are there around this world. We are just going to see one by one. The first one is the New York Stock Exchange, which is nothing but NYSE, which they are just handling the key index, which is nothing but the Dow Jones, which is nothing but the S&P 500, where the market cap is nearly 25 plus trillions of dollars. Just imagine, it's not very a small amount, $25 trillion. And the second one is Nasdaq, which is even the US stock market, where Nasdaq has been having nearly 22 plus trillions of market cap, which they're just handling all major stocks like apples and everything. And if you come to the third one, it's going to be BSE, which is in India, where it's just like handling 4 plus trillion dollars. And if you come to the fourth one, it's like National Stock Exchange, even it's from India, which they have handling the index of Nifty 50, which is like almost 4 plus trillion dollars. And the next one is London Stock Exchange, which they just handling 3 plus trillion dollars of market cap. And next one is Tokyo Stock Exchange, which they just add 5 plus trillions of dollars. And if you come to the next one, which is like SSE, which is nothing but China based stock exchange, which they just handle 6 plus trillions of dollars. And next one, if you come, which is like a Euro next, which they just handle 5 plus trillions of dollars. So these are all the biggest stock exchange or stock exchange indexes which is handled all over the world. Which these are all the big players. you know if you're like willing to invest on these indexes, you can invest. It's totally apart from your choice, but I'm just explaining these, they are the big players all over the world. And let's come to the main part, how the stock price is going to move. How the stock prices will move, tell me guys, you just tell me on the comment how the stock prices will move. First thing, company earning. See guys, it's very important how the company is earning their pennies. For example, here I just given the strong earning, it will be a beat, like almost the price will go up. For example, as a normal person, I'm just going and seeing whether the Apple company is in positive, it is like given some earnings, they just earned a profit or not. If they earn profit, what I will think, okay, company is performing good, we just invest. As a retail investor or as some people, first thing they will see the company earning, whether they are in profit or they're just growing or they're just going down. If they are in profit, I will invest, price will go up, because when the money is started flowing inside. See guys, very simple. The price, if the price is in $1, it's interlinked with two things. One is a market cap, and another one is, what is another one? Inflow. So if the market cap and inflow, if the market cap and inflow is almost same, the price will go up. If the price is $1, if the market cap and it's the outflow is like almost calculating properly, then the price will go down. You got the point. The market will go up and down in this way. Everything is because of inflow and outflow. So we can take this is inflow and this is outflow. What is inflow and outflow? The money which is coming in, for example, as a retail investor, if the money is coming in more than, if the money is coming in more than the outflow, then the market is going to go up. If the money is going out more than the inflow, then the market is going to go down. That's it, very simple. Your calculation is very simple. You need to calculate which is like going, which is like average, which is like a most like if you average the both, which is higher, whether the inflow is more or outflow is more. If the inflow is more, then the market will go up. When the outflow is more than the inflow, the market will go down. That's it. This how the market will move. This how the market will move, nothing else. The market will move like this. So for that, how the investors will see, how the people will see, how they will make the market to move. The first thing is company earning. Okay, if the company is really earning money, then you can give like around 20 marks, because companies should earn money. If you see big giants like ChatGPT and big AI companies, or like a lot of companies are there. If you see this company, they're just burning billions of dollars, to make the company to run. So they're not earning anything, they're just losing their money. Lot of companies are there, they're just losing money year on year. So if you see a balance sheet, if it's losing money, then you should give minus 20 percentage, minus 20 marks. If the company is earning money, then you can give plus 20 marks. So minus or plus 20 based on whether they are losing or they're earning. So you can give 20 marks. That's the first column for 20 marks. Next one is revenue growth. For revenue growth, you need to see whether this business is really healthy or not. See guys, a lot of people are missing out this. If you want to check the business is healthy, the main thing is revenue growth. What is a revenue growth? For example, last year the company made 10% of profit on that year. This year the company should make more than 10%. It can be even meet the alpha, like it can beat 10.1 or 10.2 also, it's fine, but it should beat the previous year. Then only company is really healthily it's growing. It can be a little bit, or it can be 15 or something, it can be more. It means that the company is growing. Only if you see each and every year, like 10% 3 years back, 2 years back 10.5, last year 11, this year 12, like that the company can grow slowly, there is no issue. Company can grow slowly, but company should grow. If you see something like this, then you can give 10 marks, 10 marks for that. If you didn't see this, if you see in alternative way, for example, if company is growing 10 percentage in 3 years back, and 11 percentage 2 years back, and last year they just made 9 percentage, and this year they just focus on 10 percentage, it means that company is in a moderate growth. So moderate growth is nothing but you have a positive outlook, you don't have any negative, but the thing is it's not growing as like year on year. Something is happening on company, we need to look even more deeper. So if you see something like this, instead of giving 10 marks, give 5 marks. You need to give 5 marks if the company is moderate growth. If the company is not moderate, see some companies are there, like 3 years back they would be 10 percentage, this year 20, like that it will be there. That is like aggressive growth. If you see aggressive growth, you should avoid that company. Why you should avoid that company is, if company is making aggressive growth, it means that they're just getting plenty of orders. If they're getting plenty of orders, it's going to be seasonal. You got my point. Plenty of orders will come only if it's seasonal. Seasonal is nothing but now the AI era is there. So if you see the AI companies, they would get a lot of orders. But after 5 years, this company won't get it. Some company would be there on that place getting a good orders, because AI is in a seasonal thing. So like that, in Corona time period, many of the peoples were buying mask. So that is going to be the season of that company. So the mask companies are growing on that time. So whomever is like buying mask, they're just buying it. So the company is growing because they're just buying mask. So mask companies are growing and growing because of something, because of some season. So seasonal growth will be giving more aggressive profit, but sudden 1 second it will give a negative profit, negative 20%, negative 30% it will give, or it will be suddenly falling down to 1%, 5%. On that time, automatically market will crash. So if you see aggressive growth, skip it. You should give a 0 mark and you should skip it. Okay. And there is one more thing is there, which is like 3 years back they would be giving 10 percentage, 2 years back it would be 9, last year it would be 7, and this year it would be floating at 5 or 12. Like if you see, like it would be positive. See, profits are positive, but company is not growing healthy. It's like falling down. So you need to be careful. You need to give minus 10 mark if you see something like this. So this is the marks you need to give before choosing a company. Okay. And the next one, dividend. Dividend is like based on each and every company's rules, and they would have a different things. But if you if you want to earn a side income by owning a stock, then dividend can help you. Okay, you can buy a dividend. So dividend, there is no other go, we no need to give any marks for dividend or anything. Next one is interest rate. If the rise of interest rate, it's going to be hurt the stock market. Why rise of interest rate is going to hurt the stock market? Okay, let me see little deeper on this. Let me see little deeper. For example, if Fed is Fed has decided to increase the interest rate from 3% to 4%, what will happen is, if they increase the interest rate, what it mean? The fixed deposit, whatever you're just going to keep on fixed deposit, you're just going to yield 4% without any risk. Investing on stock market, it's fluctuated, it can go up, come down. But if the interest rate is spiking more, people will sell off from the stock market and they will safeguard their money. See, without doing any work, without researching nothing, just locking the money, it's easily going to give 4% for you. You no need to work anything. So if a lot of people have plenty of money, they will sell off and they will put their money in FD or the safer haven, which the interest rate has been grown. If the interest rate is peaking, then it's going to hurt the stock market. That's what I just given. See, these are all the price moves and ups and downs will happen. This how it will up and down will happen. So if you see the interest rate is growing, automatically the market will fall down. This will happen. So always make sure. And next one is inflation. Higher the inflation, higher it will hurt the margin. You can see a huge sell-off in market if you see inflation is getting higher compared to this year. Last year, if the inflation is going high, if it's like staying in the same place, it's fine. If it's like increasing from 7% to 8% or 3% to 4%, what will happen is automatically market will bleed. But some scenario it won't bleed because of some IPO, some new companies, or some kind of development is going to happen. So because of that, market won't float. But most of the time, if the higher inflation is there, people will sell off from the stock market and they will go to the safe haven like gold and commodities, because they are going to pump if the inflation is going up. Okay, so if the inflation is up, stock market is going to go down. And the next one is economic data. Economic data is nothing but if this GDP is strong. For example, what are all the economic data you need to see is two economic data you need to see. One data which is nothing but GDP growth. Next one is employment. Okay, so if you see this two data, you can make sure whether the market is going to go down or not. So these reports will come frequently, it will come. So if you note down, if the GDP is growing, okay, employment, like if the GDP is growing, automatically you will lower the unemployment. Like unemployment will be lower. You will get like a lot of people will get a job because a lot of job would be created if the economy is growing. So automatically lower the employment, automatically stock market will go up. But if the GDP is going down, you can make sure you're going to be unemployed if the GDP is going down, because a lot of jobs are going to be replaced, or a lot of jobs are not there because a lot of money is not flowing inside the companies. A lot of money is not there. So if the lot of money is not there, automatically you can see unemployment rate will increase. So the market will fall down for sure. So these are all the indirect way you can see whether the market is moving up or down. Next one is geopolitical event, like elections, trade dispute, and fight between two countries. So these are all going to be the big problem. So these are all going to be the geopolitical issues where you need to see this. If any geopolitical is happening, people won't prefer to invest inside the market. They will be scared to invest. But some countries, as of now, things are happening in opposite way. Even a lot of fights are happening between two countries. Stock market is popping because of some countries, big peoples are pushing the market to not to fall down. But if you go in depth inside, a lot of people are losing their job. Anytime the market can crash, lot of risk is there. So if you see any geopolitical fights or geopolitical problem, few things will pump but few things won't pump. First thing, stock market won't pump, but if it's pumping, it's going to be artificial, or it's going to be manipulated, or it's going to dump at any time. Second one, gold, silver, and all the commodities, crude oil, and everything will pump. You can see if any fight is happening, any geopolitical change is happening, automatically crude oil, you can see crude oil is going to pump, gold is going to pump, silver is going to pump, all the commodities will pump. So, but the stock market will be dumping a lot, or it will pump and manipulate it to dump a lot. So be careful. So this how it will be happening. Next one is news and sentiment. News and sentiment also will make the market moves, but the problem is there. Because all the newses are like, as of now, it's like only coming after things have been happened. So everything is like manipulated. But even though if it's positive news, market is going even more and higher. If it's negative news, even it's going lower and lower. So even you can consider as a news as a one point, and you can take an idea whether you can invest or not. Next, next one is supply of share. There would be something like companies would be doing, which is nothing but splitting of shares, you know, buyback of shares. Lot of things are there. Lot of ways are there. Lot of things they will do. So in this scenario, the market will be pump or it will dump. For example, if they are splitting out a share and lot of shares are coming inside the market, or if they created more shares, then the market will down, like it will come down. If it's buyback is happening, and if the companies, for example, I am an Apple company, I'm just running it, and I just want to buy 1 or 2% Apple shares again to, I'm a co-founder. If I want to buy it back, then automatically the price will up, because if anyone is buying inside from the company, it means that some positive news is there. That's why they're just buying it, so that they're just holding for longer time to make a profitability by buying a share. So for doing that, if anything, you just notice something like this, it can go up or it can come down. You can make sure. Okay. And the final one is sector rotation. Sector rotation is nothing but, for example, if you take stocks like Colgate, and these are all like day-to-day life usage. If you take these kind of companies, you're just going to use day-to-day life. But already I just said you, some stocks are there which is going to pump only in a seasonal way. Like I just showed in a balance sheet, but now we can go with the seasonal way. For example, if you take a fertilizer in US, fertilizer will be used in a on spring or on the sunny time. If it's in a winter time, the stock which is like, the companies which they are selling fertilizer will get reduced, because people won't buy fertilizers on winters, because the price also will low. Same time, you can't plant anything on the winter. So these are all the seasonal change. So in that time, the fertilizer companies will be dumping. Okay. On that time, other companies will pump. For example, the sweater making companies, the companies which they are just selling salt, so that they will use salt for drying the snow or leveling the snow. Like that, lot of stocks are there which they will pump on winter time. So these are all the seasonal. Same time, that product won't pump on the summer time. So you should be very, very careful which kind of rotational shares you're just buying, which kind of company you're just investing. If your company is based on seasonal, then it was going to pump and down based on the season. So before the season and off the season, you can buy or sell based on your strategy. Even, you can build a strategy for doing this. A lot of people are doing, even you can do this. You can be, seasonal based strategies you can follow. It will work in a US market, in Europe market, and these kind of places, and all seasonal market will work very good, because I just noticed this many times. So these are all ways the price of the stock will move. If you go deeper, lot of things are there. We are just going to see lot and lot. We can see on the next video.